I actually prefer none of the screen and just a really close-up picture of you.
Okay. Yeah. All right. Let's get this started. Okay. We've got a few people not quite here yet. All right. So the first thing for today, interest tax shield. So this is something we're really going to go into much more depth into in the investments course, because this is really an issue for investors, okay? So this course, the finance course, is meant to really be focused on purely the debt side of the business and kind of takes us down to pretty much before tax cash flow and not beyond. And the interest tax shield is something that really happens after the before tax cash flow, but your author of the textbook talks about it here, so I'm going to talk about it. We'll do a quick little calculation, but you'll get, like I said, in more depth in the other course. So what this boils down to is one of the deductions that you receive on your income taxes if you own real estate, and this is one case where the crossover between residential real estate that you own as a personal residence and commercial real estate that you own as an investment are pretty much the same. There's one piece, and that is you receive an interest tax deduction off of your income. Now what that means, once again, is make sure that we're very clear on this. You don't receive a tax benefit for the full payment. You receive only a deduction for the interest portion of the payment, okay? So in other words, you don't get to deduct off of the principal portion. In other words, paying down your loan. All you can deduct is just the interest portion. So what that means is you, in essence, are going to have to use the amortization function either on your calculator or in Excel to be able to figure out what the interest paid would be for a specific loan, to figure out how much that deduction is going to be, okay? So let's just sort of start with that. All right, give me a loan amount.
$750,000.
Okay, $750,000, and once again, we're going to make the assumption this is monthly, so 12 payments per year. All right, put everything out. Okay, give me an interest rate on the loan.
7%.
All right. And give me an amortization term.
30 years.
30 years. Okay, so the first thing we're going to do is calculate our payment. All right, let's do that real quick. $4,989.77. Okay, you're right matching up with that?
Yeah.
Okay. Okay. Okay, so once we've got the payment, now if we were looking for the first year's interest expense, what would we do?
1 amort 1. Oh, first year, 1 amort 12.
1 amort 12, okay.
It's still early.
All right. Well, it's not 1 amort 12, it's actually 1 input 12.
Ah. Okay, guys, don't listen to me this way.
All right. Okay, so let's do that real quick. Principal, we get 76, 18, 57. For the interest, which is what we're searching for, 52,000, 258, 65. We want to go and get the balance over here. 742, 381, 43. Okay? All right, now then just to follow through. What if I asked you for the second year? What would you put in?
1/12.
13 and 4, or 13 and put 24.
13. Remember? January of the second year.
Rookie mistake, maybe.
Okay. Okay, and then just we're gonna do one more. What about for the third year?
36.
Yep. Make sure you're getting the logic down on that. And we've talked about it before, but sometimes you forget. Okay. All right, so if I were to just simply ask you, what is the dollar amount of interest that you would get to take as a deduction, let's say in year 3, what would you tell me?
87.59. Oh, wait, that's the principal. Yeah, I'm just gonna be quiet today.
51,117.34.
That would be the answer, yes.
And what was the question again?
Okay, once again, if I simply were to ask you, what is the amount of the interest that you will get to take as a tax deduction in the third year for this loan, what would it be? 51,117.34. Okay, if I were to ask you for the second year, it would be the 51,707. If I were to ask you for the first year, 52,258.65. Okay, make sense? Now, here's the thing, and we'll get into this, like I said, in more detail in the investments course. What is the difference between a tax deduction, which is what this is going to be off of your income tax, versus a tax credit? Because you've heard of both, yes? Okay, you've heard tax deduction, you've heard tax credit, okay?
So I think a tax deduction reduces your taxable income, and then
Correct.
it determines tax from there. Whereas once you've already determined your taxable income, a credit reduces that item, not the like above
Correct.
item.
Okay, so if you had your preference,
Credit.
and someone were to tell you, I'm going to give you a $10,000 deduction or a $10,000 credit, which would you prefer?
Credit.
Credit. You get bigger bang for the buck with the credit, okay, in the sense that it is a dollar for dollar reduction in your income tax payable. Whereas a tax deduction is simply a reduction of your taxable income. Does everybody understand the difference? Okay, so look at it like this. If we start and we sort of say, okay, we've got net operating income, and one of the things that we get to subtract out, there's more than one thing we get to subtract out, is interest expense, then that is going to give us sort of our taxable income. Draw the line a little further. So in the case that, let's say that we had 100,000 of net operating income, and our interest expense was, let's say, 30,000, then that means our taxable income is now 70,000. Okay? Now, if that's the case, and we were to not receive that, our taxable income would be, the full 100,000. Does that make sense? So in other words, the tax deduction is a reduction in our taxable income. The tax deduction, in other words, reduces our taxable income by whatever that amount of the interest expense is. Does that make sense? Yeah. Okay, so $30,000 of interest expense reduces our taxable income from 100,000 down to 70,000 because we get that interest deduction, okay? Now, a tax credit, after we've got our taxable income, then in essence we're going to multiply that by our tax rate. And so let's say that our tax rate is 30%. Okay, so in this case over here, that would be $30,000 in income taxes payable. Okay, whereas over here would be $21,000 in income taxes payable. Okay, yep.
Wouldn't you want to write it off instead because you can potentially be in a different tax bracket?
Okay. I am more than happy to go into as much detail on this as possible, but this is part of what we get into in the investments course, and I will answer that question. But tax brackets are kind of a quirky thing because most people have the belief that a tax bracket defines the total amount that you're going to be, or the percentage that you're going to be taxed at for all of your income. And that's not inherently the case, because if you go from one tax bracket to another, it's only the marginal income above and beyond some sort of set threshold that you're going to be taxed at that higher rate or different rate. It's not all of your income that's being taxed at that rate. Once again, we'll go into an example of that in the investments class. I don't have the time to get into all of the intricate details. So, but the simple answer is, yeah, you want to try to do what you can to put yourself into a tax bracket that is going to be as favorable as possible to you in terms of being as low as possible. But making the assumption that our tax rate is, let's say, 30%, then what we would be saying is, okay, with that interest deduction, okay, of $30,000, how much did that really impact the amount of income tax that we paid? Well, basically, it cut our income tax bill by what?
$9 grand.
By $9,000, okay? So, in other words, it shielded part of our income. That's where that term sort of comes from, is that basically, instead of being taxed on all of our income, we only got taxed on 70,000 of our income because we got that benefit of that interest deduction. Does that make sense? Yes or no? Okay. Now, if we had a tax credit that were to come in, okay, a tax credit would be applied here. Okay. Well, in this particular example, let's say we had 0 tax credit applied, so once again, our total income taxes payable after sort of resulting from the tax credit would be 0. But over here, if we were to have a tax credit, in this case of 30,000, okay, instead of the interest expense of 30,000, then we would end up with $0 in taxes payable. Does that make sense?
Regardless of the tax bracket.
Regardless of the tax bracket. Okay? Does that make sense, everybody? So the simple question I asked earlier was, would you, dollar for dollar, would you prefer to have a tax deduction or a tax credit? The simple answer is a tax credit, because, in other words, it's really reducing dollar for dollar your income tax payable, whereas the interest expense is only giving you a partial shield of your income by virtue of it being a deduction. Yep.
Yeah, can you give a quick example of who would issue a tax credit and what?
Okay. So, the two big ones in terms of tax credits are low-income housing tax credits. Okay, that's probably the number one of all. All right, so that if you're a developer of like Section 8 housing, you've probably heard of. All right, so housing that in essence, in one way or another, gets indirectly subsidized by some level of government. Okay, typically the federal government, but also you can have state housing authorities, local housing authorities that provide some incentives for lower income housing. But at the federal level, what they can do is, in essence, issue a tax credit for a certain, basically, percentage of the project's value and the income that it generates, okay? And so this is one of the reasons why that if you basically get involved with a lot of HUD-related programs, like housing, urban development, some of the different housing programs they have and some of the financing programs they have these tax credits associated with them, that basically the whole idea behind the tax credit is, from the government's perspective, they want to significantly incentivize a developer to develop that sort of product. And so the way to give sort of maximum incentive is to offer basically tax credits that will help to make that project, even though it may generate less income for the developer, because you're maybe maxed out on the rents that you can charge by virtue of the standards in which of what they will allow you to charge, because it's a low-income housing tax or low-income housing project. You make up the difference in those sort of reduced rents by virtue of getting the tax benefit of the tax credit. Does that make sense? Okay, I think you had a question first, or?
Same question.
Okay, all right, Cole?
So I know that like the huge players, they started out doing that and they were selling off the tax credits, and that's
Yeah.
why they're making a lot of money.
That's a whole other thing. Once again, this is not really relevant to this fact, but okay,
Just quickly.
okay, so basically,
But I know.
what you can do is, as a developer of low-income housing projects that have these tax credits, you, as the developer, for whatever reason, may not need them, or they may not be of as much value to you as they might be to someone else in a much higher tax bracket. Like, for example, let's say that you're sitting in a 28% sort of tax bracket as a developer, but yet you've got some sort of corporation that's sitting at 40-something plus percent, tax rate. They can buy those tax credits from you, from your project, and then apply them to their tax liability, and so they can get basically more bang for the buck out of those tax credits than you can get because you are being taxed at a lower rate. Does that make sense?
How much would they buy it?
Yeah, exactly.
Well, it's going to be something basically somewhat equivalent to the difference of what you're receiving and what basically they're going to shave off just a little bit, basically, because otherwise, what's the point?
Yeah, exactly.
So it's it's not, I don't think what the right word is. The pricing is going to be completely dictated by what their sort of tax rate, their sort of marginal tax rate is. And as I said, they're going to pay you maybe 90 cents on the dollar of the value of those to them, maybe 95. But there's got to be enough in there that it makes some sense for them. Now, you're saying, okay, well, does that really make sense for them to go to all that trouble? It depends on the size of the project. If you're talking about some little dinky project that's a few $100,000, they're not going to mess with that. But if you're talking about, once again, a $50 million, sort of multifamily project, they're going to be interested, because then that would be probably enough to make a difference on their tax liability. Okay?
And how do you get out of HUD requirements from a rent control? Let's say the area booms.
Right.
Now everyone around you is.
You're restricted for a certain number of years, and to be honest, I don't remember how many years you're sort
Would
of
you
locked
take a
in.
separate mortgage at that point?
Yeah, and that is not my area of expertise.
Okay.
I mean, I don't know the specifics. I want, in the back of my head, there's something like, okay, you're locked into this for a set number of years, whether it was like 5 years or 10 years or something like that, and then after that, whatever that period is, then you're potentially, able to go and become free market, Yeah, but it's usually going to be tied to the term of whatever the loan is that you probably receive from HUD as to what the limitation is, so that if you're able to cash out that loan after maybe, I think you're locked into at least a minimum of 5 years, and then beyond that, then you can potentially buy yourself out of it in some way, depending on, how strong the market is, okay? Okay, there was another, so the other piece to Brian's question. So the other big area for real estate for income tax credits is rehabilitating historic properties, okay? So that if you find properties that are, in essence, over 50 years old or older, you can get basically historic tax credits for renovating those properties, all right? And you can get more money or a higher tax credit if the property is also designated as a historic structure in a historic district, okay? So there's a kind of a tiered system of where that if it's, I think, just over 50 years old, maybe you get like a 10% income tax credit, whereas like if it's a designated historic structure in a historic district, I think it's like 20%. Okay, question?
No, you answered my question, thank you.
Okay, all right, anything else? Okay, all right, are we good with this? Okay, all right.
You have an extra calculator.
I do.
Thank you.
Okay. Pick up the pace a little bit. All right.
Just looking for that number. 25 to 36.
That's your tax deduction.
So it was 25 to 36. This one.
Okay.
36, that is the
So the next piece that we sort of want to talk a little bit about, we've already talked some about this, is the capital structure or capital stack basically associated with financing a property. All right, this is where you have to make a decision up front. Your textbook tends to kind of sort of say you've got a handful of different options or scenarios that you kind of employ. And so, the normal sort of capital stack, might be 20% debt, 80% equity. Okay? And for most commercial deals, that's probably going to be reasonably accurate. You might see 70-30 or 60-40, but normally, that is kind of the norm. Now, we could also very easily, see a 50-50. And, you could have a situation of where you almost completely reverse this, that maybe you've got 10% equity. I'm sorry. Whoops, I meant
debt.
my bad. I know what I was doing, but I reversed what I was saying. All right. Yeah. Come on. Okay. 20% debt, 20% equity, 80% debt, 50% debt. Let's be consistent. Let's just be consistent. And then over here,
80%, 90%.
Let the man work, Cal. Let the man work.
okay. All I'm really, this one is super simple, even though I'm screwing it up with reckless abandon. Okay, all right, so once again, the normal sort of capital structure would probably be 80% debt, 20% equity, meaning that you're borrowing 80%, you're putting in 20% of your own money. You could very easily, once again, have it 50-50 of equity and debt. You could also, you know, in some cases, you only want to borrow a very, very small amount and put in virtually all equity. Now, what I wanted to talk about was, okay, what are the kind of the advantages, disadvantages, and kind of each of these sort of structures? All right, let's sort of take this one kind of as, you know, a nice sort of polar extreme over here. What would you say would be the big benefit of this structure?
You're highly leveraged, so you maximize.
No, you're not leveraged at all.
Oh, right.
No, that's it.
Yes, backwards.
Okay, and basically, you've only got 10% debt, virtually all equity, so there's virtually no leverage occurring here. So what would be the advantage?
Less risk.
exposure.
A lot less risk, that in the event the project doesn't generate very much income, all you're really left with is a really low return on your equity. You're not having to worry about servicing the debt to the lender. Okay, does that make sense?
Yes.
Okay? You know, kind of the middle ground here, kind of a half and half situation. You know, once again, it just sort of, you know, steps things up a little bit in terms of the risk. And, you know, one would hope as long as the project is doing, you know, even remotely well, you're going to have more than enough income to be able to service the debt. But if you're really sure of yourself and you're really certain that the project is absolutely, you know, rock solid sort of fundamentals, then you can come over here and say, okay, yeah, we're willing to take out, you know, 80% debt and then only have to put in maybe 20% equity. And what you could find in some deals, you even leverage it up a bit more. That maybe you only end up having to put in 5% equity, or you may even find other players that allow you as the developer to put in none of your own money, and you basically are able to find financing for, you know, virtually the entire project, okay? Now, simply put, which one between equity and debt, which one is going to cost you more, theoretically? Or are you going to want a higher return on it? You're going to want, basically, your equity, you might be demanding a 15% rate of return, but your debt might only cost you 5%.
Because of the interest on the loan?
Right.
Oh, so you can get less return on your.
The whole point of basically the capital structure and the whole point of leverage is if you can find a financing source that's cheaper than the project overall return, go for it, okay? And so what we would find, if we kind of went through each of these and we sort of said, all right, so in this one, on the debt side, in essence, this is going to be 10% on the equity side, 90%. Our cost of equity is, let's say, going to be 15%, and our cost of debt is going to be 5%. So in this case, the overall sort of cost of capital okay? So when you do that, you should get about 14%, yeah?
Quick question. So there's like parentheses signs within the calculator, but like, are they not able to be used? Like if I wanted to just do like how you set it up, like parentheses 0.1 times 0.05,
Right?
that's not like a way, I can't do that on this calculator?
Not to my knowledge.
Okay.
Okay. So what I typically do, and just for my own just sort of mindset,
0.05.
is I just simply take 10 and then times 0.05, and that's why you end up with 0.5, and I take 90 times 0.15 to get 13.5, and then add those two together to get 14.
Yeah.
Okay?
and this is getting a 14% capital.
That's basically saying that for a project that has that capital structure, you would need to get a minimum of an overall project return of 14% in order for it to basically break even for the investor.
As far as cash flow?
As far as giving the investor what they want and giving the lender what they require.
Got it.
And that's not even taking into account the reality of any like fees or anything that the lender would include.
Right,
So really, you'd probably end up owing the lender more than that.
right.
So you have to get 14.
Loan
So if you have 90% equity.
Okay, let me finish the other two so we can kind of I can explain everything. All right, so these other two,
Yeah, no, it's to break even.
all right, so with this one, in this case, we've got 50% debt, 50% equity. The debt, once again, is gonna cost us 5%. The equity is gonna cost us 15%, all right? So in this case, 50 times 0.05, and 50 times 0.15. So basically, 10%. Okay? All right, and then for this one, okay, we have 80% debt, 20% equity, 5% cost of debt, 15% return on equity. Or 7%.
So,
All right, so let's go through and try to explain each of these, because all right. Now, at first glance, what I said earlier, you're going to sort of kind of question, because what I said was, and I still stand behind this, this is the least risky structure, okay? From the standpoint that you're only borrowing 10% debt, okay? So if the project goes bad, okay, really the only thing you are absolutely committed to is to pay off the debt, okay? Now, if the project goes bad, you're also not going to be able to pay yourself back, okay? But that's not what we're really sort of trying to focus on here, okay? What we're trying to focus on is that this sort of capital structure, while it requires a higher rate of return on the project as a whole for it to be successful, it is still kind of the least risky in a sense because we only have to pay back 10% of the capital structure to the debt. The equity piece is just paying ourselves. Okay, if we don't pay ourselves, that's okay. Okay, does that make sense? Now, but this also helps to illustrate the more important piece. Okay, in a perfect situation where your project is guaranteed to basically do well, and you want to maximize your leverage, you're going to go over here to this one. Because if the project only yields 7%, you're still going to get, your 15% return on equity, which you're going to be, happy with. But what if the project actually yields 10% under this scenario instead of 7? What happens? This is where the magic begins, okay? Because you're saying, okay, well, if the project overall yields 10%, well, wouldn't we just do this capital structure? Well, you could, and everybody would be happy under that scenario.
I mean, if that one yields, you're telling me if the first one yields 10%, that means we're collecting.
You're going to get a bigger return
Yeah, we're
on
getting
your
the
equity.
promote, right?
Right.
Or I don't know if it's called
So-
a promote there, but
So what would happen, keep in mind, the ones in green are your costs of capital, okay? So now if I were to go back and I were to say, the project actually yielded a 10% rate of return, okay? Then what we would do is basically kind of reverse the math and say, okay, if we got 10% here, this doesn't change, okay? It's still going to be 4, so that would mean over here, this would have to be 6. Does that make sense? 4 plus 6 is 10, okay? Then we would take the 6 divided by 20, and that would give us then, you know, all my stuff here is getting kind of messy, but basically that would give us a 30% return on equity. Does that make sense? Just working the backwards math to get there. All right? So under that scenario, we would be super happy because we far exceeded what we really wanted in terms of return on equity. We ended up actually getting a 30% return instead of only a 15% rate of return. Now, under the second scenario, this one over here, basically, if we got a 10% return on the project, then we're just satisfied. Nothing, you know, basically everybody got paid what they were expected to get paid, so nothing really changes. But let's go over here to this one for a second. What if we only got a 10% rate of return instead of the 14% that we really supposedly needed? All right, well, in that case, once again, the debt piece is going to stay the same of 0.5, but then that means over here, instead of 13.5, this, in order to add up to 10, is going to need to be 9.5. Yes?
Correct.
Okay, so 9.5, working backwards, divided by 90, would mean we would only be getting a 10.56% return on equity under this scenario. So the lender is still going to get paid their 5%, but we're the ones that are going to have to take the hit as the equity player. And so instead of getting what we wanted and what we were demanding in terms of a 15% return on equity, we're actually only going to get 10.56. Does that make sense? Okay, yep.
Just, can you do it quickly again?
Okay. So what you're doing, instead of getting 14, we're getting 10.
10%.
Okay, 10 minus 0.5 is 9.5. 9.5 divided by 90 is basically gives us the 10.56.
Because you're solving for.
Here's back solving.
Okay.
Okay?
So
On the equity.
only on the equity side.
Right. You're leaving the debt alone because lender's still going to get paid what they are going to get paid. Okay?
You're saying only if you hit 10%, then you're only getting a 10.56%. Okay, I got it.
Okay. All right. Anybody else? Questions? Okay. So the point or the moral of the story here is the overall project return of, in this case, 10%, dictates what you're going to ultimately end up with as a return on equity for the project. I mean, we can say going into the project, sort of a priori or before the project begins, we're saying our cost of debt is 5%, our cost of equity or our desired return on equity is 15%, but we, in practical terms, want to meet or exceed that return on equity if we can. And that's where then the overall project return comes into play. And so in this case, it allows us to give ourselves that much more of a rate of return on equity. Here we sort of meet expectations, and here we don't meet expectations for the equity. Okay, make sense? This is probably, if I had to say, top 5 list of things that real estate developers need to understand, this is definitely in the top 5, okay? Because this is at the core of how you basically are able to impact wealth, okay? All right.
Can you go over the 10% one again? How come the proportion on that one is 2.5? Like, I understand it equals to 10. That's not the issue. I'm talking about how you proportion it out.
50 times 0.05 is 2.5. 50 times 0.15 is 7.5.
Okay.
Add those two together, you get 10.
10.
It's just a weighted average. That's all it is.
All right.
Okay? All right. Let's move forward.
Wait, how'd you get the 15 and the 5% desired?
Those are just
Those
given.
are just
Those
givens.
are given.
Yeah. Okay.
You don't understand that.
All right.
Are those the beginning steps of like a waterfall?
No,
And,
this
uh,
has, this, well, I wouldn't say it has nothing to do with waterfall, but debt is always going to be paid first.
Correct.
Then equity is going to be paid next. But actually, one of the things that we're going to get to today, if we get the chance, is to talk about mezzanine financing, which is sort of the middle ground financing between debt and equity. Okay, it's kind of a hybrid sort of debt equity type of player, but we'll get into that later.
Okay.
Okay. All right, so the next topic. Okay, capital appreciation. So one of the things that we have talked about that you may or may not have picked up on is over time, you pay off a portion of your equity if you have a normal loan, okay? In other words, you know, principal and interest, you pay off the portions of the principal, therefore you're sort of gaining, you know, in one sense, additional equity in the project. But you're also potentially gaining equity in the project if the value of the property, the base value of the property increases over time. So, for example, you own a property in a super hot market and it goes up, let's say in 1 year, by 5%, okay, or more. Well, think of it like this. To keep things simple, let's sort of say, we kind of go back to this 80% debt, 20% equity. And we say that once again, maybe our cost of equity is 15%, our cost of debt is 5%, and that in terms of the total value of the project, we're at 100,000. So that means 20,000 is equity value, 80,000 is debt value. Does that make sense? Yes?
Yes.
Okay. Now what happens if, let's say from 1 year to the next, the value, the overall value of the property goes up by 5%. That means this next year, the value of the overall property is 105,000. Yes?
Yeah.
Okay, 5% increase. Oops. Now, what does that do to our capital stack?
Lowers the.
Okay, well, we still are going to have, in terms of our capital stack, this 80% debt. We're still going to have kind of our 20% equity, which is still going to be 20,000. This is still going to be, let's say, 80,000. But what we're going to find is we're going to have this sort of newfound equity, in this case, of 5,000. Okay? This is where it gets stuck on top. Okay? Now, the thing about that is, and the reason why we don't really completely want to readjust these numbers is, this is funny money. Okay? And what I mean by that is, unless you sell the property, you're not cashing in on this, okay? Like, and so let's say it goes up by another 5% the following year, another 5% the next year. Until you sell the property, that's not real, okay? I'm sorry? Now, if you were to refinance, then yes, you could pull out, you know, some of that money. But barring that, this is just, it's kind of like paper profits with owning a stock. The same sort of thing. You buy the stock, you know, in a company for $100 a share, you know, 2 days later it goes up to $110 a share. Okay, you can say, yeah, my value is you know, $110 a share, but that's irrelevant until you actually sell it. Okay, to a certain extent, it's a lot. I mean, even another example that's even more extreme is you go to the casino. Okay. You take $100, you bet on black on the roulette table, you get $200, you say, woo, you know, I'm up $100. Well, you know, in one sense that's real money if you walk away. But you're probably not going to walk away. You're going to probably take that, you're going to plow it back in, and eventually you end up with nothing, okay? So, but the point is, all of this, you know, revolves around basically making sure that you understand that this is sort of paper money. But, having just said that, if you were to sell the property, that means that you would have an extra $5,000 of equity that you have gained in the property. Does that make sense? Yes or no? Through capital appreciation. Okay? Is everybody cool with that? Yes or no?
That's hard equity, that's your money.
But this, yeah, the $20,000 is hard equity, the money that you've actually put in. This is just sort of, I don't want to say it's called found money. I mean, in one sense, you've earned it by doing the investment, but yet you don't really realize it until you cash out of it. Okay? Now, having just said that, if we were to sort of, you know, cash out of this deal, and like for example, let's sort of say, how do I want to do this? So, in this case, we could say that if the value were to go up to that 105,000, then how much equity did we originally put in? We originally put in $20,000, okay? And in this case, without really doing anything extra, sort of our return on equity for this, we would get an extra of what?
20%?
20%. Okay? Just from the capital appreciation. Does that make sense? Okay? All right.
So 20% increase in
your equity in the house.
And 20% return, yep, 20% increase in your equity. But now, what if, hold on. What if you also sort of were to look at it a little bit differently? You were to say, okay, let's go back over here to the 15% required return that we wanted, all right? So, of the required return that we wanted on this, so let's just say, just to keep things simple, if we had $20,000
You didn't put the other $5,000 in.
and we got 15% on that in the first year, that would mean $3,000 over the 20,000.
Oh, I see what you're saying.
Which would be 15%. Okay, hold on.
That's
Just give me a minute. Okay. All right. So basically, in the first year, our return on equity is basically 15%. Does everybody see that? In other words, what you're doing is you're taking the 20,000 of equity, you're multiplying it by your required return on equity of 15%. That gives you $3,000 of income. Yes? Okay, so 3,000 divided by the 20,000 that you have invested would give you a 15% rate of return in the first year. Okay, now we have calculated the incremental return already of the 20%, but the combined return, if you will, for the second year would actually be
You have to
5,000 plus the 3,000, which would be 8,000 over the 20,000.
40.
So that's going to give you a 40% rate of return on your equity.
And that's solving for what? You said incremental? The
Incremental.
So you're getting 40% more in year 2 than you did in year 1?
No.
How
You're getting,
much?
Is that supposed to be 20?
percentage-wise, it doesn't add up, but you're getting 20%.
25%, that's a miscalculation.
Is that a miscalculation?
Yeah.
All right. So 25% incremental rate of return on the 5% extra that you were getting in the sort of phantom income or phantom equity, okay? And so you've got that plus the 15% that you got in the first
Gotcha.
year.
So that's just for the full 2 years, that's how much you've appreciated your value past
Yes.
your 20,000 capital investment.
Yes.
Gotcha.
So in the second year, you're getting a full-on 40% rate of return, whereas in the first year, you only got a 15% rate of return.
If you sell.
If you sell. Okay? Because of the price appreciation. But now, here's the thing. If you were to be putting this in as a cash flow, not trying to make this overly complicated, but if you were putting this in as a cash flow for time periods 1 and 2, your cash outflow at time period 0 for equity would be 20,000. Yes? Your cash inflow for year 1 would be the 3,000. Your cash inflow for year 2 would be 8,000. And then whatever happens subsequent to that. Okay? Does that make sense? Okay?
Just to confirm, 40% you're adding up to 15% and 25%.
Yes.
So you're taking the original 15%, the 20,000 or the 20,000 divided by 15%, getting 3,000 dividing it by 20,000, you get 50.
Yep. So all we're really saying, just this is, I want to simplify this as much as possible. All I'm really wanting you to be able to do is to say, okay, how do we come up with basically this overall return on our equity for that second year? Okay, so you've got to take the return from the first year, you've got to add it to the return from the second year, plus, well, you've got to take into account, once again, the additional $5,000 gain off of the value increase,
So you're just
the capital appreciation.
okay. So to simplify it, you're just taking, for example, you're getting the $3,000 from the 15% is what we want, and you're just adding that to the appreciation, which
Correct.
is 5,000, and then dividing it by 20%.
The equity.
That's it.
That's it.
And that's your return after the second year if you sell?
That's your return for the second year. Okay? Your cash on cash return for the second year. Okay? Okay, moving forward.
Wait,
Can I ask a quick question? What prevents you from getting 40% just doing cash flows on the calculator? If you just input 20,000, 3,000, 1,000 in 3 years, you can't get to 40%?
Well, no, because then you've got to assume a sale, a
Okay.
reversion.
Okay.
I'm just, we're saying this is one way to sort of think about it in terms of if you were to sell the asset, this would be the return you would be getting for that year. Yes, Rebecca?
Oh, I didn't hear you finish the, all we're trying to do some summary.
Okay, once again, all we're doing is we're taking basically the income the property is generating of $3,000. We are adding that to the property appreciation of the $5,000. That's giving us $8,000 of value creation that we then divide by our initial equity of $20,000, gives us a 40% return on equity.
And that's happening all year too.
Well, once again, you can't look at it quite like that because the way that once again, this is paper money. Unless you sell the property, you don't get to keep it.
Okay, so hypothetically, if you sell
Right.
in year two, you'll get that.
Right.
Is that true? That's how you're gonna ask it if you sell, boom, boom.
Yeah. Or what is your return on equity for that second year? Okay?
Fair enough.
Okay. Let's see. Okay. Cash flow return. All right. So let's say that we've got a property and we've got an annual net operating income of, let's say, $100,000. Right? And we've got interest expense of, let's say, $30,000. Okay? And that's in essence going to give us $70,000 in sort of taxable income. All right. And if we're looking at this on a before-tax basis, all right, let's say that we've got a property that is valued at let's say $1 million. What would be our cash on cash return for that property? Okay, how much money are we earning?
Is that the property values of the whole,
That's a
like, is there a loan to
value?
value built into that?
In this particular case, let's just say this is the overall.
Like loan amount?
Actually, let's do it this way. This will make it simpler. Let's just say the equity value is this.
Oh, okay.
All right. Equity value of $1 million, and we have taxable income of $70,000. So 70,000 divided by $1 million. .07 or 7% cash on cash return.
So we're getting $70,000. Like, I understand cash on cash. The first cash is like taxable income.
Well, you're not getting
So
that
we're
cash.
basically, we're sort of,
100,000 net operating.
we're saying this is the dollar amount that we are receiving, in essence, after we have paid off the interest off of the debt. Make
So
sure.
that would be like our cash flow, like essentially our profit in a sense before tax.
Right,
Gotcha.
okay. So really simple calculation, once again, operating income, subtract your interest expense, get the taxable income, divide that by your equity, gives you cash on cash. Okay? All right.
So cash on cash is the same thing as return on equity?
Well, not completely, because in this case, we, let's just see. Indirectly, I guess it would be, but it's just a question of how it kind of gets sort of classified. Because here we're looking at it as if just from the cash flows, not really from the cost of capital per se, whereas the other sort of takes into effect what the actual independent cost of capital are, both the cost of debt as well as the cost of equity. But here we're showing the actual numbers. Okay? All right, moving forward. Mezzanine finance. Okay, so what we've talked about is that our traditional forms of financing are going to be debt and equity. Okay, debt being obviously money we typically would sort of say we're borrowing from a bank or a traditional sort of financial institution. Equity being money that we and or our business partners put into the deal. Well, there's also sort of this middle ground called mezzanine financing. Okay, now the word mezzanine, just in case you've never heard this before, any of you that have ever been to a hotel, you typically have the lobby, and then the next floor up is usually referred to as the mezzanine before then they begin where then the rooms, you know, from that point forward. And so this mezzanine is kind of meant to be, it's a sort of this middle ground, all right? And so in terms of how it gets treated is, those of you that have any sort of background in undergraduate sort of finance, one of the things they talk about is sort of hybrid debt, or they talk about preferred stock, or they talk about, you know, things that have sort of characteristics of both debt as well as equity. That's kind of where mezzanine falls. And the reason it falls there is a mezzanine player could be someone like a venture capitalist, okay, where in essence, they're going to want a higher rate of return than you're paying on debt, but they're usually not going to require as high of a rate of return as your equity players are going to get. And the reason is they're going to get paid first, or after. Debt's going to be paid first, they're going to get paid right after debt, but they're not going to be paid before the equity player gets paid. So in other words, in terms of your sort of waterfall piece, this will be the priority. Debt gets paid first, mezzanine gets paid second, equity gets paid third, okay? So normally you're going to have corresponding kind of rates of return associated with this. So you might have a 5% cost of debt, a 10% cost for mezzanine, and let's say a 15% cost of equity, all right, in your sort of capital structure. Now, the thing about these mezzanine players, they can take on a variety of different forms. Usually, they're going to be people, they're going to be intimately familiar with a particular product type, okay, whatever that product type is, whether it's apartments, whether it's office buildings, whether it's industrial parks, whatever, that is kind of their sort of playground in terms of what they're going to be most familiar with. Now, sometimes with these mezzanine players, they want to have a little bit more say in what direction the project goes than what the debt players typically are going to have. Your debt players in an ideal world are pretty much just simply silent money partners, okay, for the most part. Now, once again, you can have some very active lenders that, you know, really do get up in your business about different things, but for the most part, the lenders have traditionally been, as long as you pay me, I don't really care, okay? Whereas the mezzanine players tend to be a bit more involved in the deal structure, in the transactions, in terms of decisions that are of any significant, you know, basis they want to get involved with, okay? And usually want to have a say in what actually takes place. But here's part of the reason why that tends to be the case. While we may have that, our capital structure in this case, if we've got our equity down here, and let's say that we've got our mezz, we've got our debt, all right? Well, we could have a situation of where that, why do I keep doing this? I keep reversing this here. It's one of those days. All right. So in this case, our equity up here, or debt down here. All right. So in this case, let's say that our debt is at 80%. Okay, and traditionally we've sort of said that our equity might be at 20%. But now with this mezz player, we can still borrow the same percentage of debt, but what we can do is potentially reduce the amount of equity that we have to put in. So we might be able to do a situation of where the mezz player puts in 15%, and then we, as the developer, might only have to put in 5%. Does that make sense? Okay, so it allows us to put in less of our own money, but yet we're taking on these quasi business partners, okay, in the deal. Okay, does that make sense? All right, so in this circumstance, we kind of go back over here in terms of our cost. Our cost of debt is 5%, our cost of mezzanine is 10, and our cost of equity is 15. Okay, now in terms of coming up with kind of a weighted average of these, if we wanted to, we could say, okay, we may want to start out with what is our weighted average cost of debt, okay, and we can sort of say mezz typically tends to swing on the side of debt more than it does on the side of equity, so it usually gets lumped in on the debt side, okay? So if that's the case, what we would do, pretty much take 10%, well, actually, we want to be consistent. 15% times 10% plus, in this case, 80% times 5%, okay, for our debt. So basically, kind of the weighted average between just on the debt side would be 5.5. Okay. Now, if we add in the equity piece to this, we would have basically 5% times 15%. And with that, we get 0.75. So if we take just the debt piece, 5.5, we add in 0.75 for the equity piece, the overall cost of capital would be 6.25. Okay?
Would that be your weighted?
That'd be the
like your
overall weighted average cost of
But
capital.
would that be like the same thing as like a WACC?
Yes.
Okay, cool.
Okay? But in terms of just the mezz and just the debt, what you could do is actually, let's say that to be more accurate, let's assign dollars to it. this will make it easier. If we say that basically this is 5,000, this would be 15,000, and this would be 80,000. Okay, so for a total of, once again, 100,000. What you could do is simply say, all right, we've got 15 plus 80,000 is a total of 85,000 debt. Yes?
I'm so sorry, was it 95?
I'm sorry. 95. Less than I am just functioning. All right, 95,000 would be our total debt, the 80,000 plus the 15,000. All right, so of that 95,000, what we're basically saying is that 80,000 of it would have a cost of 5%, and the remaining 15,000 or 15% of the total would be at 10%. And let's see.
What?
Okay, hold on. Let me redo it down here. All right. So we've got our mezz. 15,000, we've got our debt at 80,000, total 95,000, okay. Our cost would be at 15%. I'm sorry, our cost is 10%. Cost is at 5%. That's 1,500. $4,000 for a total of 5,500. All right. So in this case, 5,500 is our overall cost of debt. Okay, does that make sense?
Yeah.
All right.
Could also multiply the 5.5 times 100 too, right?
That's why I worked it out both ways.
Gotcha,
So that's where you get 5.5 up here.
gotcha.
Okay? All right. All right. Moving forward.
So we're just, for this finance, we're really just looking at the cost of debt as far as the equation, or the.
Right. Okay. Yep. All right. All right, we've already done an example of this, but we're going to do another one. Weighted average cost of capital. All right. So.
Actually, one question.
Yep.
So you said that the mezz and the debt was the debt financing. What would be the equity included in that? What would you call that?
Well, that's what we're getting to.
Oh, okay.
Okay. So the weighted average cost of capital combines all three, okay? Whereas that would, what we did there was just the cost of debt.
So that wasn't the way, he asked if that was.
Okay, the overall,
No, the
this was the
6.25.
weighted average
Yeah.
cost of capital, 6.25,
Because we added in the
Equity.
0.75.
which includes the equity.
Okay. Not costing that.
Sorry.
Okay,
The 5.5 was,
is the cost of debt.
right, but times, is that a
Plus.
2.5 or
Plus.
Oh, this, okay,
5.5?
this is adding in our cost of equity or our return on equity.
Yeah. Okay, so
I
cost.
mixed the two together.
Cost of equity
So-
though?
You treat
Well,
mass.
return on equity. Your return on equity is, in this case, 15%, but it comprises 5% of the overall capital structure. In other words, you're only borrowing, or you're only putting in 5% equity. You're borrowing all of the rest. You're borrowing 95% of the project value. you're putting in 5% equity in that deal. But all we were trying to do with this one was simply to isolate the debt component and say, of the total, what is our cost of debt? And our cost of debt was the $5,500. Now what we're doing is we're kind of going back, we're sort of saying, okay, let's put all this together in terms of a weighted average cost of capital. So here, we can handle this a couple different ways. We can sort of say that the weighted average cost of capital is equal to our percent debt times our cost of debt as a percent plus our percent equity times our return on equity as a percent. At its fundamental basis, that's the weighted average cost of capital. Now, if we add in, okay, we've got our debt, our percent debt, times our cost of debt as a percent, and we add in a middle piece of percent mezz financing times the cost of mezz plus percent equity times return on equity, then that would be our weighted average cost of capital, basically just adding in the mezz financing. Does that make sense?
No.
So that's all we did right above, okay? We just basically apply that same sort of formula, all right? So now let's just work through another quick couple of examples with this. All right, so cost of debt, let's say, is what? Or percentage debt is what? We'll go ahead and use 80. All right, 80% debt, or cost of debt, 5%. Okay. And equity would then be 20%. And then the return on equity, we want 15%. Okay. So we do the math on that. So it gives us 4. It gives us 3. So overall, for that example, our weighted average cost of capital would be 7%, much like we had found in a previous problem. Okay. Now, with the mezzanine, we have still 80% debt, and our cost of debt is still 5%. Okay, so we do the math on that, that's still going to be 4. Now we have the mezz piece, and we've also adjusted our equity piece. So our mezz piece, in that previous problem, we said that was going to be 15% of the overall capital structure, and then leaving us 5% for equity. Okay, our cost of the mezz was going to be 10%, and our return on equity required was going to be 15%. All right, so we do the math. So here we get 1.5. And here we get 0.75. So if we add those all together, we end up with the weighted average cost of capital of the 6.25. Okay, so all I've done is just rework the problem, made it a little bit cleaner than what we had up above. Okay, does that make sense to everybody? Yes or no?
Yes.
Okay. So, the lesson, if we sort of look at these, are two alternatives. What are the trade-offs of going from this capital structure to this capital structure.
Lower cost of capital.
Lower cost of capital, lowers our cost of capital from 7% down to 6.25, so that's good, we're happy about that. Okay, what else?
Lower upfront costs.
Or lower,
I'm sorry?
Lower like cash up front, I believe.
Absolutely, that is probably gonna be one of the biggest benefits, is we have to put in less cash up front under this capital structure.
To get the same return.
So basically, you get the same overall return on whatever money you put in. Okay, is that right? Follow that. Okay, so now, why would we not want this capital structure possibly?
More risk.
Okay, possibly more risk, but more specifically,
You're gonna lose control of what you
control.
wanna do.
Because of the mezzanine player, you're probably gonna lose some control over what you can do with the project, because they're gonna be constantly wanting to give you their opinion about, you know, what they think you should do, and if you don't listen to them, well, they're not gonna give you the money, okay? So, you give up some control, but in return, you're still gonna get paid what you wanna get paid, and overall, it does mean that the project as a whole doesn't have to perform at as high of a level simply because of your cost of capital is lower. But what that also means is, all things being equal, this is the way to think about this, much like in that earlier example, what if the actual project does yield a much higher rate of return than expected? In other words, this is your cost of capital for debt, mezz, and equity. So what if it does yield a substantially overall return of like 10%? What happens?
You make more money.
You're gonna make more money. Now, this is where it gets interesting, because your debt is gonna stay fixed, okay, in cost. But the mezz may or may not stay fixed, okay? And what could happen there is they might be able to participate in some of the upside of the unexpected income that you would get from the property. Does that make sense?
Yes.
Okay, so in other words, their return, and once again, this is where you get into the deal structure, which is really more of the investments course, but the point is that it could be that if the value or the overall rate of return of the project goes up to, let's say, 10%, then that means you can give them more action here. Instead of giving them a 10% return, you might be able to give them a 15% rate of return, and then potentially give yourself maybe the remainder. Does that make sense? But in the agreement that you would have with them, you would specify, you know, how that would work. That any excess revenue, who would get it, how would it be split, when do they get paid, that sort of thing. Does that make sense? Okay, and there's no one absolute way to do that, okay? Okay, questions? Yep.
So, real quick, like as far as, I know you already spoke about who would be the mezz, but like, would just be basically like private investors?
Could be me.
Could be you, or just anybody who wants to be in on the deal?
Yeah, you come to me with a deal and I say, okay, sure. You know, I'm interested in the deal and I'll play the role of the mezzanine player, but you know, you're gonna constantly have to listen to what I have to say in order to potentially do the project. But it also could be just a group of, you know, investors. But it, you know, and technically in some cases it could be, depending on restrictions, certain types of financial institutions that have more of an investment arm to them than just the traditional banking functions.
Or like a private equity fund?
Yeah,
That would
right.
be a mezz.
It could, yes. Okay, all right. Other questions? Does it make sense? Okay, all right, so let's do this. We're probably gonna take a break. Let me just look. Yep, let's take a break and then we'll get to the last 4 topics and then we'll be ready for the quiz.
Quick today.
No, it's been just like the cold weather. My allergies.
Professor, is it possible you could scroll up to the first column? What's going on, sir?
I was like,
How's that?
Ran out of paper, dude. It's not like a fly.
I watched like half of the video. I was like,
yeah, but as long as you do well on this one.
That's a lot this week.
I got frustrated after the first video and almost pissed off because he didn't teach shit of what he was supposed to. I don't know. I'm about to lose my patience.
What, with,
San Miguel.
Sure.
Yo, serious. I didn't even finish the second video.
today I'm
Did
going
you?
to be like, hey, stop talking
I have to
about
listen.
Excel.
I went through it, but I didn't get it all in my spreadsheet because I had issues with calculating the debt service stuff.
Yeah, I mean, did he say that that's gonna be the last video that he was gonna do?
He said it's going to be the
Yeah,
last,
the last of it.
intermediate video, so the next ones are going to be way more intense.
I don't know why he stopped like building it out, like in the video. Like, he just like has
He
it
just
ready to
opens
go.
it up with it there, and I'm like,
And half the time you
Took
can't
a
see what
while.
he's referencing or like it's ridiculous.
Well, it took a while for this one because he gave us the assumptions ahead of time, and then I was like, I set up the spreadsheet and then I had to like build a whole new spreadsheet.
How long did it take you?
So the second video took me like probably 2 to 3 hours to get through. Because I didn't watch the spreadsheet, I just stopped, built the spreadsheet, and then tried to get through the rest.
Yeah, I did that too. I got frustrated. That's not learning.
I was done after I got through.
You should do the Excels in class because it's more live questions versus emailing, waiting for a response, being paused on your work. And you can't,
Exactly what I said.
versus you could do videos of quick events all day. And it's better.
Exactly what I
supposed to
said.
be-
Nobody's gonna ask you questions on that.
Exactly.
I was emailing him to like 11.
Did he answer immediately or no?
He did.
he did
But like I
perfect
kept him
answer
on.
me.
But he doesn't respond like freaking paragraphs.
Well, yeah, and it's confusing, but
Yeah, exactly.
I'm he's good.
Did you get through it?
Could you scroll to the next problem, please?
What?
Could you scroll to capital structure, please? Thank you.
I don't know. Has everybody
Nope,
said
nope.
the same things too?
Yeah. It's the first time I'm teaching that class. Well, Corey did it last year, but he took over this year, so.
Gee, I wonder what everybody else thought.
What is that gonna do with it? Like, are you gonna pass me? Or what? 'Cause you're-
Yeah, but I want to learn.
Yeah.
I was so excited on the Excel model. I was like, what's going on?
It's like the most important thing. It's like literally the most important fucking class.
People get paid money to do this shit.
This is literally the most important class. But it's also like it's difficult because like he'll go over concepts like whack like first week, and now we're learning it in this class, you know. So it would definitely help if they're like matched up.
He has a structure, just jumps all over the place.
His videos this week. Like,
I love your face though. You're like, wow.
Oh.
Maybe 3 more weeks.
3 more weeks I'm done. I think it's more Excel,
I think it's 3 or 4, right?
Three,
I think it's 3 or 4. Right?
we can't. You just say we're done with today. We just started.
Juanita, how many weeks left?
4.
Including this one?
4 more drives to Davie for us. Yeah. That sounds boring.
Yeah, so 4, and then next week's 3 too. Okay,
Yeah. Or include. You're already counting this. Today is done.
Yeah, like it's
Jeez.
basically 3. 3 more waking up at 6.
Today is.
We've already woken up.
Oh, you wait at 6. Wow, okay.
Today is
Oh, nice. 7.
Yeah.
You should know this.
6, that's too early.
What time do you wake up?
7.
You're closer. I see.
Oakland 95. I'm not buying it.
No breakfast, nothing like that.
Starbucks.
On the way. So my
Breakfast
friend's
with Shenanigans.
He's got, they have their just order ready when he shows up.
I should just get stocked that place.
You keep the.
Your project auto, like they can get their coffee. Come on. Mobile order. Oatmeal. Salty.
Okay. Now to discuss some things that aren't in your book. All right.
Why are you guys doing that? Not gonna look at it.
You did the same thing.
Okay, so one of the things, whenever you're trying to make these borrowing decisions that you want to kind of explore is sometimes you have a situation of where one lender will offer you a certain amount of money at a certain interest rate, and then you have another lender that will offer you a different amount of money at a different interest rate. And you want to be able to sort of figure out, make an apples to apples comparison of really what is your basically cost of borrowing $1 amount over potentially another dollar amount. And you'll sort of see as we kind of work through this example of what I mean by that. So let's say that we go into borrower A, and the deal that they want to give us is $80,000 loan, and they want to lend that to us, let's say, for 15 years. Once again, we're going to assume monthly payments, so 12 payments per year. All right. And at an interest rate of, let's say, 5%. Okay? And so we'll go ahead and we'll calculate whatever our payment is here. But then we have another lender down the street. They're willing to lend us a little bit more. They're maybe willing to lend us $90,000 for 15 years. At a 6% interest rate. Okay, so before we do the calculations, let's just talk about the setup and try to understand mechanically what's going on and why this is sort of important to us. All right, so let's just say that we're trying to finance a $100,000 property, all right? So in this scenario, that means we're able to borrow 80% or $80,000. Yes? Okay. Over here, we're able to borrow 90% or $90,000. Okay. But we've got to pay a little bit more in interest. Okay. So what we're really trying to compare here is how much more are we really paying for that extra $10,000? Does that make sense conceptually? Yes or no? Okay. Now, your initial gut reaction is to say, oh, we're paying 1% more. No, you're not.
We're borrowing more.
Well, you're borrowing more, but it's not just that. It's where else could you get money from? In other words, let's just say you have the option of doing A and then possibly finding another lender, lender C, that would lend you just to $10,000. How much could you afford to basically pay C and still be ahead of what the deal you would get with B? Does that make sense? Okay? Well, it's not just 1%. That's what you're going to see with this. Okay? First of all, let's do the payment calculation for both of these. Okay. Everybody match up with that, yes?
Yes.
Okay, now, let's sort of say, okay, well, we've got lender C, 12 payments per year. They're going to give us the difference. $10,000 loan between these two, okay? $10,000 difference. It's also going to be for 15 years. Okay? But their interest rate, we're going to, in essence, back solve for it. What we're going to do is we're going to say, what is the difference between the payments for lender A and lender B, because that would all be attributed to what is the difference for that extra $10,000. Yes? Okay?
You're saying that would be the difference for the $10,000, but isn't there also like a 1% increase built in that?
Okay.
Like, isn't it hard to compare with
Well,
that?
that's why we're doing it this way. Just hang with me for another second. Okay, so the difference between these two is $126.84, okay, in the payment. So if we were to put that in here as a negative payment amount, and then solve for the interest rate, that's what we get. Okay? So this is the part that's meant to surprise you. Because the reality of what's actually happening here is that $10,000 extra that you're getting from lender B is really not just costing you that extra percent. The reality is it's really costing you 13%. Okay, because of the difference that you would be paying in the payment. So in other words, what we're sort of saying here is you can go to a lender C and they can charge you up to 13%, and that's going to be an identical deal to getting basically the deal that we're getting from lender B.
With combined with A, like
Right.
A and C.
Well, yeah, A and C would then basically be equivalent to B. Okay? So the moral of the story would be, if you can find a lender C that will give you something less than 13%, like let's say that you could get lender C at 10%, you're going to be substantially better off by doing that with A as opposed to doing B. Does that make sense? Okay? So this is how lenders screw you, okay, in very simple terms, because they lull you into this whole thing of, oh yeah, well, because in many cases this is the same lender. Okay, they're basically saying, all right, we'll give you an 80% loan at 5%, or we'll give you a 90% loan at 6%. You're saying, okay, that's great. That's only an extra percent more for that extra amount. No, the reality is they're charging you 13% on that $10,000 difference. Whereas you could probably go find a third-party lender that would give you the $10,000 at a much lower interest rate than 13%. Does that make sense? Okay, that's why it's called the incremental cost of borrowing. Sort of like the marginal cost of borrowing, in the sense that what is the cost of that extra $10,000 in terms of the actual sort of borrowing cost? Does that make sense? This is also probably in my top 5 sort of things for you to understand, because this, if you can understand this, you will have a much better way of comparing one lender with another lender in terms of the deal you're really getting.
So you're just whipping out the calculator and just, you know what I mean? Like you're just shopping around rates.
Yeah, he's on the phone. So when you had your own personal commercial real estate dealings, is this something that you were doing often? Like when you had a deal, were you doing like how many lenders were you?
Constantly, lenders will throw out this sort of stuff.
But how many lenders would you go through before you'd make your decision? Like 5, 10, like how?
Easily 5.
Yeah.
Easily 5.
Easily 5.
Do you have like a
That's
set?
outside your relationships or additional?
It totally depended on the deal. In some cases, they would chase you. You know, they would literally say, oh yeah, we knew about this project you did here or that project here, you know, come and talk to us. And then, you know, but also keep in mind, part of it is you as a developer, you as an investor, you have a tendency to sometimes want to be lazy. And what I mean by being lazy is you want to say, okay, I'm going to stick with the same lender only because it absolves me of a lot of brain damage. And by brain damage, I'm talking about going through all of the unique, quirky, specialized, nuanced circumstances associated with each lender. This lender would want tax returns for just maybe the past year. This lender might want tax returns for the past 10 years. This lender wants, you know, this application that's 20 pages long. This lender wants a 1-page application. This lender's willing to give you, you know, a 6% interest rate. This one's willing to give you a 7% interest rate. This one's willing to give you a 4%. You know, I mean, so it's like all of those things, you know, and like the other things I've talked about of like, well, this one also requires you to give them documented, audited financial statements once a year. Whereas this one doesn't require them at all. This one requires them every 6 months. This one requires, everyone is different. That's what I'm saying. When I say lenders are like retailers, that's what I mean. Every single one is different.
So sometimes it is worth paying the extra percent.
Sometimes.
Okay.
If you can avoid, because think about it like this. If you pay that extra percent, you pay more than maybe you should. If you're only planning on holding the property for a couple of years, that difference, you know, to avoid the brain damage is probably worth it. Okay? But if you're planning on holding the property, you know, for 30 years, you're, you know, planning on, just continuing to nurture that relationship with that bank and try to negotiate, you know, better deals in the future, it might be worth, you know, sticking with them. And what I'm trying to also articulate is, if you're a large-scale lender, or large-scale borrower, large-scale developer, you have people on your staff whose whole job is to do nothing but source out the absolute, positively best deal that they can basically grab hold of. And so they're going to look for shaving off every little, you know, nickel that they can to try to, you know, make the deal as good of a deal as possible. And when we start dealing with, obviously, millions of dollars, that easily pays for somebody's salary to do just that and that alone.
So are you setting up personalized spreadsheets and then that's how you're kind of underwriting deals quickly, or are you using some other tool?
No, just do a spreadsheet comparison. Okay. Okay. Other questions on this? Pretty cool though, huh? Okay, once again, just another way the lender can take advantage of it. Okay, moving forward.
That should be in my class.
Okay. Yep.
When you're seeking different lenders, were you running your personal credit each lender you went to?
Pretty much, yeah.
You have a 30-day window for that, huh?
Okay.
You have a 30-day window
basically getting
inside that.
more-
So they all bundled together?
Every time you look for a new lender,
Yep. Yep. But that's not as bad as people think it is. I mean, just having an inquiry on your credit is not what I think it really used to be.
Doesn't credit not really matter when you're borrowing these big sums of money?
Well, it's another thing. It's a question of whether or not, and we really haven't talked about that, which we should, the difference between a recourse note versus a non-recourse note, okay? Some lenders, especially in the past, were very open to non-recourse lending, which means I'm a developer, I come in, I bring in a deal, and I say, okay, this is a $10 million deal, I'm gonna put 20% down, and you're gonna finance, you know, 80%, and we're all smiles, we've signed the deal, but the non-recourse means in the event that this property blows up in some way, that rents are not forthcoming, that it ends up defaulting and failing, the lender cannot come after me personally. It's non-recourse. I mean, they can't come after me for additional payments or additional funds, okay? In other words, I am totally in the clear. I can just literally toss them the keys, say, take the property, it's yours. I don't want to have anything to do with it. Now, I lost my 20% equity, but I don't have any further recourse in the event that they're not able to sell the property for the amount that they have financed it for.
It's not like hard money, like there doesn't affect.
Well, yeah, okay. The other side is what is much more common, which is going to be lending with recourse. And under those circumstances, the lender is going to be much more concerned about your own personal financial viability as a borrower, because then they can come chasing after you and they want to make sure you do have substantive assets that potentially they can attach, or that you would use as additional collateral for the deal in the event that this project blows up, that there's another project that they could maybe take the possession of to sell and satisfy whatever debt that they have outstanding against you. Okay?
And what's that determinant? Like what?
Once again, lender by lender. Okay? As to how much recourse, or in other words, how much additional collateral that they may require you. But like another piece of this is they may have what's called cross collateralization, which is, in essence, let's say that you're buying 5 properties that are virtually identical. So 5, let's say, duplexes, or 5, fourplexes or something, and they're virtually all identical, maybe in the same general market area, but yet for the purposes of a loan, you choose to do 5 separate loans on each of those properties under 5 different LLCs or whatever for, kind of keeping everything separate. But whenever they go to collateralize the loan, then they may want to cross-collateralize all 5 loans, meaning that if one of them blows up, they can then pick from any of the others to basically sell off to satisfy their debt. Does that make sense? Now, as a borrower, you don't want to have to do that unless you have to do that. Because in essence, you're putting other properties at risk. Okay? But it's quite common for the lender to ask for that just because they know they can.
I thought under like an LLC, it protects the individual from the actual.
Well, the whole purpose of putting potentially in different single-purpose entities is then if, like for example, let's say on this property, at some point something catastrophic happens. I don't know, that a bomb hits it and it literally blows up. And then if it was secured by the same loan as all the others, then potentially the lender could come chasing after all of the others. But if it's in a single-purpose entity, then only that particular asset would ever be affected in the sense that that would be an asset that you would lose, and then the others would still remain intact. Or if somebody does the traditional slip and fall or whatever, and in essence it's on that property, and your liability insurance is simply not enough to cover it, well, instead of you basically losing all these others, you would only lose that.
Okay.
Does that make sense?
So the limited liability.
Yeah, it's normal for a lot of people to do that, to simply say, for liability purposes, let's just put every single piece of real estate in a separate ownership entity and have a single loan on each asset so that it keeps it all very nicely stratified, because at some point I may want to sell off one of those. Well, if I've got one loan covering all of them, that begins to be a problem, because then you have to do this carve out, and then the lender has to agree to it. They're probably going to want another refinancing fee, and it just gets messy. Okay? Now, I don't want to get too much into this, but if you're a home builder, okay, you buy a big parcel of land, and you go to a lender and you say, all right, I've got this big parcel of land. Now, in many cases, on the residential side, you typically bring the land into the deal, and that really becomes your equity. And the loans that you get from the lender are typically then going to be just for the actual structure themselves. But in the odd case that you were to be able to finance a portion of the land, or you have a situation maybe where you have bought the land from some individual, and then they would have to potentially, each time you were to sell a house, they would have to do what's called a release provision and release each lot kind of individually within that, let's say, 20-unit subdivision, so that that person could then take on that property with that debt, with, you know, so forth, so on. Now, that's assuming, you know, one of the things that has become, strangely enough, popular in some high land cost areas are ground leases. Okay, and we're going to get to that a little bit later in the semester, but the short version is this, that you as the homeowner may not own the land underneath your home. You may be doing like a long-term ground lease, and the reason you would agree to that is it's lower cost. But potentially at the end of, let's say, 20 years, 30 years, whatever structures on that land reverts possibly to that landowner. So we'll get into that later. Okay, moving on. This is the one topic that everyone just absolutely cringes. Adjustable rate mortgages. Okay, also known as variable rate mortgages, but most commonly known as adjustable rate mortgages, or ARMs. Okay. Over time, as technology has changed, so have the mortgage offerings have changed. In the beginning, the simplest loans were what kind of loans that we've talked about in here?
Interest only.
Interest-only loans, okay? Required the least amount of math, the least amount of calculation, doing on pencil and paper without really any difficulty whatsoever. Then you sort of migrate into the constant amortization mortgage, which was also a little bit more complicated, but still pretty much could be done on pen and paper without too much difficulty. Then we migrated into the constant payment mortgage, the normal sort of traditional, you know, mortgage. Then sometime in about the 1970s, whenever we had a little bit more automation, computers to be able to do calculations, thus emerged the adjustable rate mortgage, okay? The adjustable rate mortgage was born out of technology and out of interest rates that were out of control, okay? I remember, you know, as a kid, one of the first things I was given by my grandparents as a gift was a small little certificate of deposit. But that certificate of deposit, back in the 1970s, I just remember this to this day, 13.5% on a certificate of deposit.
So that's your first gift?
Yeah, that was like my first.
That makes so much sense.
You know, certificate of deposit.
That explains everything.
13.5%. And you know, to this day, I mean, you can only hope that you could ever get 13.5% on a certificate of deposit. I mean, you know, now there, in many cases, you know, 1-2%, something ridiculous. Okay.
How long was it for? Like, is it like?
It was like a 5-year thing. But anyway, the point is, interest rates were out of control. They were completely wacky in the 1970s and early 80s. And it was just kind of like, it was crazy land. But as a result of that, as we talked about before, if interest rates go really high, what happens to real estate prices?
Low.
They go low. But you had inflation occurring, you had all these other things kind of happening, and so you had real estate prices and real estate loans that were just, it was just absurd, and people weren't able to afford anything because of these outrageous interest rates. And so, in essence, what then began to take place is lenders said, okay, we got to come up with a solution to this because we want to start lending money, you know, to be able to basically do some home loans. So why don't we do adjustable rate mortgages where maybe we can lock in a rate for maybe just a year or two, and maybe at a lower rate than what maybe the overall prevailing rate might be, and then with the expectation that if it goes down, it goes down, if it goes up, we benefit from it, you know, so but it changes maybe from 1 year to the next or 1 month to the next. And actually the very first loan that I got back in 1991, I guess it was, on a home loan, like I told you, it was 8.5%, but it was also a variable rate mortgage. And so 1 month it would go up to, let's say, 8.75, and then almost the next month it could go down to like 8.25. And then, you know, it just basically, you know, just kind of this up and down, you know, sort of thing. Well, the problem with the adjustable rate mortgage is it requires a lot of calculations, okay? Much better suited for Excel than on the calculator, but we're going to show you the mechanics of it on a very basic level using a calculator. So, let's just sort of start off, and in this case, let's say that we're going to do this on an annual basis to keep things simple, so 1 payment per year. We can do it on a monthly basis, but we're going to do it on an annual just to kind of keep things simple. All right, so let's say that we've got a $100,000 loan. And we're going to have 15 payments over 15 years. And let's say that our initial interest rate, and we're going to use a term here just because it's just kind of what happens. Let's say it's a really low interest rate of 2%. And we're going to call that rate, because it's a really low interest rate, a teaser rate. The reason why it's called a teaser rate is it's meant to purposely attract you to this loan and say, "Woo, look how low that interest rate is." You know, we're basically really taunting you, we're teasing you with that really low interest rate to make you come to our, you know, bank as opposed to somebody else's bank, because we're going to give you that low introductory rate. Okay, does that make sense? Yes? Mm-hmm. Yeah. All right. So initially, we're just going to calculate the payment as we ordinarily would. Just going to make sure your calculator set on 1 payment per year. Okay, so the annual payment on this, $7,782.55. Okay?
I don't, so like, I got that also, but how is the payment, like, wouldn't it, I don't know, I'm just confused. I guess maybe it has to do with the principal and whatnot. But how is it so high? Like, how is it not just like 2%?
Well, no, this is for an entire year, not for a month.
Divide by 12.
This is like,
Oh, I see what you're saying.
it's an annual payment, yet, I'm only doing this for the simplicity of the example.
Right.
Normally, it would be monthly. Okay, you're going to thank me because if we did it monthly, you'd have a shotgun to your.
Thank you.
Okay, just trust me on this. All right, now, all right. So we get to this point, and so for year 1, our interest rate we said is this teaser rate of 2%. But in year 2, it's going to jump. Maybe to 5%, okay? And maybe it'll stay that way for another year. And then in year 4, maybe it goes up to 7%. All right? And then it stays that way for years 5 and 6. And then year 7, all the way to 15, let's say it goes to 8%. Okay? So basically we've got 1, 2, 3, 4 different interest rates that are going to be applied to this loan. Okay? Be a lot of calculations. Okay? Now, here's the way you have to think about this, okay? There's a logic to this. And this is where you're going to get lost. And by the way, this is the A question on the test or the quiz today. Only the A students will get this, okay? So if you do get it, you're not going to be an A student, good for you, because this one is going to be the most challenging question. All right. I'm not telling you to set you up for failure, I'm just telling you it is the challenging question. Okay, so here's what you have to do. Every time every time the interest rate changes, you got to treat this as a new loan with a new revised balance of the loan. Okay, and you'll see what I mean as we go through this. But the best way to conceptualize this is what we're going to have. We're going to have 1, 2, 3, 4 different loans. Okay, because of the interest rate changes associated with them. But we're also going to have different balances, because what we're going to have to do is we're going to find the balance here at the end of year 1 to apply this interest rate to. Then we're going to find the balance at the end of year 3 to apply this interest rate to. Then we're going to find the balance here at the end of year 6 to apply this interest rate to. Then we're going to have to put all of that into a cash flow function to be able to find the overall effective cost of borrowing for the loan over the duration. Does that make sense? So it already sounds horrible, doesn't it?
Yeah.
Okay. All right. So, let us start. Now, keep in mind, this is annual. That's why I'm doing you the favor with the annual, because otherwise, that many more buttons to push and calculations and things to keep in the back of your head. But the logic is still the same. All right, so in this case, end of 1 year is going to be 1 input what? No, that's
1.
1. It's annual.
Right.
Okay? First mistake. All right. All right, let's see. Oops, I'm on here. I'm getting not working all of a sudden. That's not a good sign. Okay. 1 input 1, shift, amortize. And what we can do, all we're looking for here is the ending balance. So we're just going to go ahead and put 3 equals to give us the balance. Okay? And once we've got that,
We're only looking for the imbalance?
yeah, we don't need the interest or the principal for this piece of it.
Can you
Okay.
just, like, why? Like, why are we just looking for the balance? Like, because we're only
Okay,
trying to
you-
find.
Do the calculation.
Because you need that in order to do the next interest rate. Remember, you're setting up these different loans.
So we're trying to figure out, like, what our total balance would
Give
be
me,
at the
give me a
end.
chance to go through it.
Absolutely.
Okay. All right, so we do this. Okay, so our balance at the end of year 1 is 94,217.45. Okay, now what we have to do is basically draw a line and put in that 94,217.45, and we can just do it right here as our new present value. Okay? So that would be basically our new present value. Then, what is the remaining term of the loan? How many years?
14.
14. 14 is our new term. What is our new interest rate?
Can you clear all and then do that?
You have to start all over
What
again.
happened if
What
you
do you
miss
mean?
one and make one mistake?
You screw up.
So you can't clear it and then start with the new
You
present
can. You
value?
can start with the 94,217 present value.
And then just keep repeating that?
You don't have to clear it.
You don't.
No.
Just put,
I'm trying to show you the shortest way to do it.
Okay.
Okay?
you just click present value.
Okay. So our new interest rate is going to be 5%. Okay? We're going to get the payment for that. Here's what I'm going to do. I'm going to actually go through, I'm going to do the complete setup, and then we'll do the actual keystrokes. Okay? So, okay. All right. So we get that. Then that interest rate lasts for how long?
2 years.
2 years. So as I said, you treat it like it's a brand new loan. All right? So in this case, we can do either 1 input 2 or 2 input 2, doesn't really matter.
Same number, because it's
Yep.
the imbalance.
Yes.
Hold on, why
Yeah,
wouldn't you
explain
put
that.
1 input 3?
Because you're starting as if it's a brand new loan.
But the interest stays the same in year 3 too?
No, interest rate is now in, trust me on this.
No, I'm saying year 2 and 3 is 5%.
Yes, but is now the next, year 2 and 3 is now years 1 and 2 of the new loan.
Okay.
Yes,
So then why are you doing?
So you can do 2 and 2 or 1 and 2. I don't, either one is fine.
Two and
We can do 1 and 2. It's gonna give you the same answer. Okay? Okay, then we put that in as present value. Then, okay, after those 2 years, how many years do we have left?
12.
12. What's our new interest rate?
7.
Okay, 7%.
Solve for payment.
Solve for the payment. Okay, how many years does that interest rate last?
3.
3.
So 1, 2, 3.
Yep. Okay. Then we have how many years remaining after that? 12 minus 3? 9 years remaining. At what interest rate? 8%. Okay, we get our payment. Okay? All right, so that's the first part of the setup. Okay, so let's go through, let's do that.
But isn't at the very end, there's like a one input?
No, you don't need to do that. Okay, just trust me and I'll explain.
I trust you.
Okay. All right, so we go through, we've got this, we put that in as our new present value, 14 as our new interest rate, 5% is our, I'm sorry, 14 is our new term, 5% is our interest rate, solve for payment. 95, 18, 22. Okay, 1, input 2, shift, amortize, equal. We get 84, 362, 39 as our new present value. 12 years, 7%, get our payment. Okay. 39, and 1, input 3, equal 69,284. Put that in as present value. 9 years remaining, 8%. Get our payment. Okay, does everybody match up to that point?
Yeah.
Okay? Okay, we're halfway through.
It's the same process all the way through, though, right? It's just keep
Right,
going.
give me the worst options.
Okay, now then.
Inappropriate.
She's funny.
Could you scroll down? just a little bit?
Okay. All right. Now, okay, here's the way we have to look at this. If we're looking at this as our effective cost of borrowing or the lender's yield, what we're going to be solving for, in essence, is really kind of like a weighted average of that interest rate. Okay, depending on how much time it was financed at this interest rate versus this interest rate versus this interest rate. So the way we do that is this a cash flow. All right? So from the lender's perspective, how much did they originally give you?
100,000.
100,000. So once again, 1 payment per year. Clear everything out. All right, then you're gonna put in 100,000 as a negative, from the lender's perspective, cash flow. Okay?
How many do the one
We're gonna be solving for the lender's yield.
How many do the one input, whatever, 15%? That was from year 7.
You don't need to. You'll see why. Just give me a minute. All right. So, what cash flow is the lender going to receive in year 1?
$7,782.55.
Correct. They're going to receive $7,782.55. So from their perspective, that's a positive number. That's cash flow. What number are they going to receive then for the next 2 years?
$95.18.22.
Now we have a choice, because it's happening more than once, to just put the number in and put it in twice, or to use basically the n sub j function, which does it for us, saves us a teensy bit, not a whole lot, of calculator entry. So we can just enter 2, that happens twice, shift n sub j. Then we get 10,621.39 as the lender, and we get that for how long?
3 years?
3 years. Okay.
And then the 11,077.
Then the 11,000, all kinds of issues today. 11,077.65 as cash flow, and that cash flow occurs how many times?
9.
9. Okay. Then we simply solve for internal rate of return. And that gives us our effective cost of borrowing, or the lender's yield. Okay. And the loan's paid off at the end of the 9th year, so we don't need a balance because it's paid off.
Neither do I want to take this. What if I take it?
One mistake.
It's more great. It's crazy.
1, 2, 3, 11,000. Oh, you don't have to, you don't have to add the final balance because we're paying off the entire loan.
Okay. You did it correct, you should get 6.11. That is our effective cost of borrowing for the loan. Okay? So what you thought was this wonderful little loan at a 2% teaser rate ended up being 6.11 overall.
I mean, it's not terrible.
No, but the point being is that you thought you were really getting a 2% loan. But see, here's the other piece to that I left out. Whenever you were qualified for this mortgage, you were qualified at the 2% interest rate. Meaning you were qualified for a much more expensive property than probably what you could maybe afford if interest rates go up significantly. Well, you're saying, well, why would a lender do that? Because that basically sets you up for failure in the future, that you may not have enough income to be able to make your payment. Well, the original lender, in many cases, is going to sell off this loan into a portfolio, but they don't give a hoot about what happens at some point in the future. All they care about is as long as you make the payment for the first, year or so, and whoever buys the loan is buyer beware, to them at some point in the future. So if you end up defaulting, as your payments go from $7,700 a year to $9,500 a year to $10,621 a year to $11,000 a year, too bad, so sad. It's not my problem as the original lender.
This doesn't happen anymore though, right?
Not as much.
Not as
Because
much.
they offer opportunities for like arms for a certain amount of time, and then you can switch to fixed. Like,
Right.
so, what is?
There's always, let's put it this way. And one of the next problems, you're going to kind of begin to see that much more. There's almost no limit to the creativity of lenders as it relates to extracting money from the borrowers, okay? And they're going to come up with a new product if it helps them to make more loans and hopefully extract that much more in terms of a rate of return from the borrower in the process.
Is there also a loan that's reflected based on their interest rate? Like, so it's only going to go up if, like, it's not predetermined how much it's going to go up. What is that?
That's actually what happens in reality.
Like
Once
a
again,
market rate adjustment almost?
Yeah, exactly. What will happen in reality? As I said, this is sort of teaching you how to play checkers. Okay. Chess or this would be every single month your interest rate goes up or it goes down. Okay. And then that basically starts this whole process all over again. Okay. And with that, that may be tied to some sort of a specific rate, whether it's, you know, it could be a consumer price index, it could be LIBOR, it could be federal funds rate, it could be, you know, the discount rate, you know, it could be almost anything, depending on what that lender chooses it to be tied to.
But don't you think it's smart now to be able to do that because interest rates are so low and they're not gonna rocket and then everyone's gonna default if they can't? It's not possible.
Anything is possible.
Well, I mean, it would
No,
be very
it really
unlikely.
is, because, I mean, all we have to do is look back historically, and things that you never thought would happen, happened. Like in the 1980s, no one was really thinking that Congress was going to change the tax law and all of a sudden remove, you know, tax shelters from real estate as being a real, where you could have passive losses that were virtually infinite. And then ultimately it ends up destroying the real estate market because you have all these people that were investing in real estate for all the wrong reasons, just basically to get passive losses. They didn't care whether the property made money. They were able to basically take and offset other income that they had. Maybe they were medical doctors, attorneys, or other professionals, non-real estate related, but then they would buy real estate assets like shopping centers and office buildings and in essence would hold on to them. The benefit was those properties could lose money left and right, but then at the end of the day, they were getting all the tax write-offs, so it was almost like they were getting property for free by the time everything was said and done. So all it takes is one tax law change to totally, completely devastate or turn the market in a totally different direction. And that's in addition to whatever the Federal Reserve potentially does with their, you know, open market operations of raising, lowering, you know, and buying, you know, setting reserve requirements and all that other sort of stuff. So, you know, it's just, there are a lot of moving pieces, is all I'm saying. So to say that it's not going to happen, that you're going to have a substantial increase in interest rates, you know, look at all of our, you know, many of our Latin American countries and kind of what's happened with them with respect to, you know, I don't want to get political. Okay? Let me make sure that I'm making this, you know, very clear. But let's assume that the country as a whole moves in a more social agenda driven kind of context where the government is going to be responsible for many more things, okay, in terms of payments and whatever to individuals for whether it's healthcare, education, a whole number of, you know, issues. What impact does that have potentially on the economy and then ultimately interest rates in terms of investment and so forth, so on? It can be catastrophic, okay? This is non-political as I can put it, okay? All right, moving forward.
Quick question.
Yep.
The balance at the end of the 9 period there?
Would be 0.
Okay, that's a good check.
Yeah, because at the end of the 9 years, it's 100% paid off, in this case.
In this case.
Okay? All right, moving forward.
Professor,
Yep.
when you start on the, on year 2 and 3, are
Yep.
you entering the, where do you enter the,
Right here.
okay.
Okay. All right. Okay, if you thought that was wacky, this one's wacky.
Great entry.
This one's not as difficult, but it's wacky, okay? All right, price level adjusted mortgages. These are fairly rare now, but they still exist. You can still do them. Basically, what this does is, as a lender, it can give you an extra little boost in your rate of return. Keep in mind, the lender's objective is to obviously, number one, get paid back, but also maximize their return in terms of what they're extracting from the borrower, okay? The lender's not lending you money out of the goodness of their heart. They're lending you money because they want to make more money, yes? Okay, so that's the way you simply have to look at all of this. Anything that they can do to potentially enhance their yield, they are going to do it, okay? Now, what keeps them maybe from going too far are regulation and competition, okay? But outside of that, you know, to a certain extent, they can do a lot of things, okay? It's like even another example. We can talk about predatory lenders. Let's say you have a horrible credit history. Let's say you have a horrible employment history. Let's say that, you know, you're the biggest risk imaginable, okay, to a potential lender. All right, you're not going to get a loan with a normal traditional bank, okay, with those sort of characteristics. So what are you going to be forced to? Potentially go to alternative sources of financing. You know, basically one step up from payday lenders, okay? And what I mean by that are lenders that are basically going to say, yeah, we'll do a real estate loan for you. You've got horrible credit, horrible, you know, income, horrible background, but you know what? No problem. We'll do the deal with you. But they're going to figure out a way to charge you an outrageous interest rate, you know, to basically do that, and probably have all sorts of conditions placed upon that loan that they can yank it away from you in a moment's notice if you are so much as 1 day late on the payment, okay? Does that make sense? So just kind of keep that in perspective when we are talking about some of this.
Hard money lenders fall into that?
Yeah, to a certain extent. Okay. All right. Price level adjusted mortgages. Basically, your mortgage balance increases or decreases as an index increases or decreases. What I mean by that, the most common would be like consumer price index, okay? Consumer price index is technically made up of what? Like a basket of goods and services that, you know, every so often the federal government kind of comes in and sort of says, all right, let's go and let's price milk, let's go and price bread, let's go and price gasoline, let's go and price housing, let's go and price, you know, all this sort of stuff. And they kind of roll all this into kind of one singular number that they will maybe say is like a consumer price index that, you know, prices on average are increasing by 2.5% a year, or decrease this year by a couple of percent. Or you can have some other sort of index, especially if it's housing related, that could be, okay, what are housing prices doing in a particular market, or overall? The lender sets the index, whatever the index is, but then they are bound to that index for the loan duration. Does that make sense? So up front, you know what index it's going to be tied to, in essence, where the changes are going to occur and when they're going to occur. You just don't know by how much. All right? So let's just sort of start with this. 12 payments per year. Put everything out. And we'll start with another $100,000 loan. And the only reason I sometimes use the $100,000 loan is because obviously it makes it easier to kind of relate to what's really going on. You kind of think of that as a nice round number. Okay. So let's just say this is a 15-year loan. And much like in this one instance, they're going to offer maybe a teaser rate, 2%. And so we go and we want to calculate our monthly payment. All right, so let's just, before we get in too deep into this one, what the lender is doing here is they're going to keep your interest rate constant at 2%. So for the entire loan, your interest rate is always going to be at 2%. What is going to change is how much you owe the lender in terms of the balance of the loan, and then that's going to be reflected in whatever your payment on the loan is going to be at any future time. Okay, so let's explain how this works. So first of all, let's get our payment. Again, it's 12 payments per year. Okay, so the monthly payment, $643.51. All right, everybody good? Now, what they're going to do is they're going to make adjustments. At end of year. Okay, so in this case, at the end of year 1, and let's say end of year 2, and so forth, so on, they're going to make adjustments either up or down, depending on what happens with, let's say, this index that they've picked, whether it's consumer price index, housing index, whatever. All right? So at the end of year 1, the adjustment upward, not the interest rate, but your balance is going to be adjusted, let's say, a positive 1.5%. Okay? And in year 2, it's going to be maybe adjusted another 2.5%. Okay? And then, let's say at the end of year 2, pay off loan. Because you realize it was a horrible idea. Okay? Now, so let's just see what we have going on here. All right, so what you're going to do, we're going to calculate the balance of the loan at the end of that first year. Okay, so start with that. Okay, so the balance is going to be $94,225.15. Okay, nothing is unusual up to this point. Okay, everybody with me? Okay, now this is the part where it gets unusual. Okay, so what's going to happen is at the end of that first year, the lender is going to make an adjustment upwards of 1.5% on the balance that you owe them. Now, you're gonna say, why in the world would they do that? Why in the world would we agree to that? Okay, well, they're doing it because they're saying the value of that property has changed over that time period. So therefore, we want that reflected in the amount that we're actually lending you or have lent you. So in other words, they're basically saying you owe us more money because the property value has gone up. Does that make sense?
So they're stealing your equity.
They're stealing your equity. That is the perfect way to think of it.
Those thieves.
They are stealing your equity, okay? Good. All right? So, what you're going to do is simply multiply that balance times 1.015. Now you're saying, well, okay, why? Because obviously this is, you're multiplying it by itself plus 0.015. In other words, 1.5%. Whereas this next year, it's going to be 1.025. Okay? You're multiplying it by itself plus the 1.5%. Okay? So that is going to give you then a new balance of $95,638.53.
Everything else is the same?
Up to this point, yes. Okay, now, what happens at this point is, just like with the adjustable rate mortgage, you're basically going to sort of say, that is now my new balance on the loan, so you would put that in as your new present value. Okay? Then you're going to come down and you're going to say, okay, I have 14 years remaining. My interest rate is still going to stay constant at 2%, so we don't need to change that. But what you do need to resolve for is
Payment.
the payment, because your payment's going to go up. Okay?
Interest stays the same?
Yes.
Okay.
So your payment goes up by basically about $10 a month. Okay? You right, so with me?
Yes.
All right. Now then, if we want to sort of continue on with this example, the next year is going to be months what?
1 through 12.
1 through 12, because you're starting over just like you kind of do with the adjustable rate. So 1 through 12. What are you getting?
I'm getting 90,000,
Yeah, this
115.
one different.
I got 89,658.
Okay, all right. Looks a little bit low for whatever reason.
Yeah, that's what I was thinking. The balance decreases 6,000 in the first year anyway.
Yeah, that's right. Okay, yeah, I don't know, it just struck me as one I wanted to double check. Okay,
It's
65. All right, so we now then multiply it by 1.025. New balance, 91,921. That becomes our new present value. Now we're down to 13 years.
Well, didn't we pay it off at the end of it?
Well, Yeah, so we don't really need to mess with it, okay. So if we were to just pay off at the end of the 2 years, that would be the payoff amount. Okay?
So, okay,
So we, yeah, we're done.
so that's the end of year 2 payment?
Correct.
Gotcha.
So the balance that we would owe at the end of the 2 years would be the $91,921.
So the adjustment happens before the payoff?
Yep. You might want to cash in or cash out, whichever way you want to look at it.
And if you wanna know what the lender is making on this?
Then you would put this in basically as a series of cash flows. So in essence, I'm not going to ask you to do that, but if I did, what you would do,
Payments?
yep, so you're going to put in 100,000 cash flow. Then you're going to have, what's the deal today with this thing? Okay, so your first set of payments is going to be $643.51, and that's going to occur 12 times. Then your next set of payments is going to be the $653.16, and that is going to occur how many times?
12.
No.
24.
It's going to occur 11 times.
4K.
And then your 12th payment for that year is going to be the $653.16 plus the $91,921 as a singular cash flow. Then you would solve for internal rate of return to get your effective cost of borrowing on that.
So we don't have to know that, but it's good.
You don't, but you know, you never know. You might see it on a final exam. All right.
Some people might see it on the final exam. Yeah, exactly. I'll just take the end. Your notes or something.
I know, bro. How you writing to like clean the fucking smoke?
Huh? I have like serial killer handwriting, bro.
You were gonna give me your notebook and the quiz, I would fail.
Okay. So the effective cost of borrowing is not as horrible as you might think it would be. Ends up being 3.88 rounded. So, but keep in mind, your actual stated rate is 2%. So it's not quite double, but certainly it adds on there in terms of your cost of borrowing by virtue of increasing that balance. Okay?
And you got out early.
And you got out early in the sense that, yeah, you only did that for 2 years. Okay? And then, oh yeah, that's the fun part about this, because then if you add all this stuff up together and you basically do every single one of those possible adjustments, like the prepayment penalties, the loan origination fees, everything, you know, and it's just like, woo! It's all
Can you
right.
lower it 1 second, please?
Yep.
Please.
That's true.
So when you sign up for that loan, they're telling you those adjustments in the, you know you're getting those adjustments, or those
Yeah, I mean,
adjustments
it's, you don't know what they are though.
That's what I mean, how do you, when you find, that's because.
You don't find out what those adjustments are
Because it's based on the index?
until they charge you for them at the end of the year. Right.
One more.
Okay? All right.
After you've been billed.
Okay. for today, I know you're excited, is basically the effect of below market financing, all right? So here's what can happen. Let's say, you have so many different scenarios, but we're going to try to keep it really simple. You've got a property that you want to buy, that let's say that I own, and I'm willing to maybe owner finance it for you, okay? I'm going to be the lender, I own the property outright, and I want to score and score big, okay? And so one way that I can do that is I can offer you the property at an interest rate for you to finance it for me lower than maybe what the traditional bank will offer it to you for. Now, it means I defer my gain on the property basically for maybe several years, okay? Maybe many years. I mean, like one of my I financed for 30 years. And I sort of look at it like that's part of my retirement, okay? And so, in essence, let's say that the traditional bank rate might be 6%. But I tell you, I'll finance it to you for 5%, okay? But here are all the different things you need to be thinking about. I'm not going to require you to get an appraisal. It's my property, why do I need an appraisal? I'm not going to require you to get a survey. Once again, my property, why do I care if you get a survey? I'm not going to require you to get an inspection. I'm not going to require you to get, I don't even want your tax returns. I don't want anything. All I want is for you to start making payments to me for the next 360 months. Okay, does that make sense? All right, so to a borrower, that should be pretty attractive, yes?
Yes.
Okay.
I don't know anymore. Isn't owner financing?
What?
Is owner financing normally not 30 years though? It's like
It can be anything you want it to be.
Normally it would be like way less.
Yeah, it depends on what a person's wanting to achieve. You know, in my case, I want cash flow until, you know, maybe I'm in my 70s or 80s. Okay?
Makes sense.
You know, but everybody is different in terms of kind of what they want, okay? So you can set it up, like I did, as a contract for deed. So technically, I'm still the owner for that entire 30 years until they make the final payment and pay off the balance, then ownership transfers.
Is that like legit, like what you have with?
Yeah, it's legit.
For that one property? you
Yeah,
have?
that's why it's called a contract for deed, okay? Because it's basically it's lease to own.
Gotcha.
But you don't own it until you've made your final payment, okay?
So you're responsible for all the tax liabilities?
No, I have them pay the taxes.
Oh, you're Junior.
Hold on, what?
You're holding them.
And ripped it.
Yes.
Hold on, what? Can you explain that?
I'm sorry?
I'm literally working on an owner financing deal right now, and the one thing that's like scaring me is that the payments are gonna go up because it's his homestead.
Right.
If he moves, then the tax exemption
Right, goes away.
Yeah, inflates the price. So like,
Right.
so how does that work?
You're just gonna have to deal with that because I mean.
Well, I'm saying you said that you make him pay the taxes.
It wasn't a homestead.
Ah,
It was commercial property.
okay. Interesting.
Yeah. Okay, so getting back to the scenario. So basically, I'm offering the deal lower interest rate than the bank and no brain damage. You follow? Okay? And I may or may not even require a down payment. Because my perspective is, I'm just looking at mailbox money, okay? So for me, whether I get a 5%, 10%, 20% down payment is immaterial. Because I'm just looking at it from mailbox money perspective, and I can yank away the asset at any time that they are delinquent, because it's not a traditional foreclosure. I still own it, okay? So they miss a payment, or they're late on a payment, I can instantly say, property's mine.
It's an eviction, right?
Yeah. Okay. Make sense? Now, so the question is, and this is where it gets interesting, is how much of a value difference can I potentially charge as a price on the property as a result of not only the lower interest rate I'm willing to offer, but also the lack of brain damage and the lack of down payment. You follow? Okay, so let's take a look at this. All right, so let's just say then with $1 million property. All right, 12 payments per year. All right, and we sort of said that the traditional bank financing, and let's just assume, just to keep things simple, we're going to try to keep apples to apples, not get into the down payment and all that other sort of stuff, just try to do a simple apples to apples comparison just on the dollar amount, okay? So 6% interest rate for 30 years, and let's get a payment. Okay? Then change the interest rate to 5% and get a payment. Okay? So basically, if the borrower goes to a traditional bank, they're going to have to pay roughly $6,000 a month in their monthly payment. Yes?
Was it say traditional?
Traditional lender.
Oh, okay.
If they basically go with the owner financing, they're only going to have to pay $5,300 a month. Okay? Does that make sense? Yes or no?
Yeah.
Okay? Now, what is the difference in those two payments as a dollar amount? Okay, so do the simple math.
You mean as far as the interest?
$627.29 difference per month. So basically, by financing with me, they would save $627 a month as a monthly payment. Does that make sense, yes or no?
Yep.
Okay, is everybody kosher with that?
Yep.
But I know that. So what can I do?
You can screw them. You can be a predatory lender.
Jack up the
I can
price.
raise the price of the property, in essence, okay? Think of it like this.
What if it's cash flowing? Why do it?
Just hang with me, okay? This is where I get distracted. I love the questions, but
Just not yours.
The flow.
What's wrong?
I think that's what screwed me up. It's like, okay, so in essence, they're getting away under this scenario without making any sort of adjustments to anything. They would be paying $627 less per month by going with me. Okay, is everybody with that? Yes or no?
Yes.
Okay, so what that means is if they end up making those payments for the next 30 years at, in essence, this amount of the 5368, whatever, that is, the amount that obviously, we sort of look at it another way. Let me try to, let's do it this way. Let's probably make it simpler. Okay, so per month times 360 months. So that would be their savings
Total.
in raw dollars over the 360 months if they were to finance it with me versus a traditional lender, okay? That should be an absolute no-brainer, okay, from their perspective, okay? And then, sort of from my perspective, you know, I'm saying, all right, I'm in essence getting what I have asked for the property, let's say $1 million, but the reality is, if you really want to look at it another way, I'm getting this dollar amount per month, right? Total. So what does that work out to be in terms of total income to me?
$1,932,000.
So basically twice the price,
Right.
Right.
okay? But now I've had to wait 30 years to get all of that income. But, you know, from my perspective, it's the equivalent, in one sense, of me taking the lump sum of kind of $1 million and putting it in a bank account and earning 5% interest. You know, this way I can, in essence, I'm earning that 5%, obviously, the whole way through, and that's what's obviously driving up, in essence,
And you
the
potentially
total.
own the property still, God forbid, should anything
Correct.
happen.
So at some future date, if they default, I repossess the property
And do it again.
instantly, and then are able to eventually resell it again and start the process all over. Okay, does that make sense?
Yep.
Okay, now, we still haven't answered the question that I'm trying to ask, which is, in essence, what is the value of this to the borrower, and could I even inflate the price even more?
Let's do it.
You know, so, because if you're the borrower, okay, you're happy, in one sense, you got two options. Keep in mind, you've only got two options. One is to finance the property with me at 5%. One is to finance the property with the lender at 6%. Those are your two options. Okay, is right? Okay. So, I have a little bit of leverage in one sense that I could say, you know what? I'll, you know, basically, I could just say, well, you know, why would I even bother offering them 5%? Why would I not just simply say, I'm going to give you the same interest rate as the bank, 6%. You still don't have the brain damage that you have to go through with the bank, and maybe down payment, and so forth, so on. So, you know, I could very well just say, yeah, screw that, I'll just charge the same as the bank.
Loan origination fee too.
But I could also potentially, you know, there's a whole bunch of different things I could potentially do. And I know at the end of the day you're concerned about what do I have to do on the quiz to, you know, obviously solve the problem. But the interesting thing is what the borrower has to, you know, sort of say is, if this is the amount that I'm going to have to pay the lender, to a certain extent, I could be just as happy paying me that same exact amount, and there's no really net loss, you know, to the situation. And in so doing, then I could obviously inflate my return substantially, but I could also, by, you know, doing that, in essence, you know, back into, if I'm only wanting a 5% rate of return, that means I could really be adding that much more value to the property in terms of the amount that I'm actually getting on the property. Okay, it's a way of looking at it, is all I guess I'm trying to say. So let me just make sure that I have covered.
So what's the answer to that question?
Well, let me see, make sure I worded it the way I want it worded.
Yeah, what's the question?
Okay, so in this case, the maximum cash value difference is that.
So that's what we're looking for.
Yep.
The tax
Is
rate
which?
difference multiplying it by 360.
Yep.
Is the $1 million the loan value?
In this case, we're basically.
The property value.
It's loan value and property value, we're just assuming 100% financing for the simplicity of the property.
So how would you
Simplicity of the
Problem.
problem, thank you.
how would you inflate the price
Yeah,
based
by $1
on
million.
owner financing? You didn't get to
Because
that
there's
part.
no,
So if you were to do
This-
traditional financing for 5%, then the property is not, it's obviously they're not gonna be paying $1 million. Because if he goes down in financing, how are they gonna, he's gonna get $1 million extra dollars?
what are you saying right now?
The issue is,
saying
in this
$1 million
particular
30
case,
years, that's
I am getting basically I'm giving a 5% interest rate on the $1 million loan and getting paid back basically this amount each month for 360 months, which means I, not the borrower, but I would be getting 1.9 million. But what I'm asking in the question is simply, what is
The difference of the payments.
basically the total difference in the payments over the 360 months?
Let's start with that question.
Okay. All right, I think we're ready. All right.
Yeah, Paul, did he answer the question?
Right.
Yeah, but like he did it in a
Before this class
confusing way.
gets out, you
Oh, but
tell
yeah.
everyone to sign up for that webinar they got an email for yesterday.
Okay, everybody sign up for that webinar.
Yeah.
That we emailed for yesterday.
Exactly, it's in your email, guys.
Okay. You want to get a quick break before this?
Yeah.
Okay, 5-minute break. We'll start at 5 after.
See, look, that would be
Plus
what that would be.
0.01% if you do the.
See, I don't know what the $1 million represents, right?
The
Because
present
That
value,
was a-
quote unquote present value, or the
share?
sales value. But I don't see how he increased the price or lowered the price
by $1 million.
by doing owner financing.
Yeah, that's confusing. That's very.
He made the money.
Well, no, that's not, that's.
Well, I know he's receiving the cash flow, but how are you as a consumer
You
seeing
could
that?
pay me more for the property, an extra $200,000 technically, but you would discount that by basically whatever the prevailing interest rate is to find out what in present day dollars that difference would be.
But if you
I didn't ask for that though.
if you multiply the traditional payment by 360, it's like 2.1. That's.
Right. And so the difference between those two is basically that dollar amount.
Is it 225?
Difference between,
And what questions do you want to ask Cole that you are getting me off track on?
No, I mean it pertains to this, but like I don't know. I'm just missing something. There's a disconnect there because the present value is $1 million, but then you're saying the owner financing you're going to be receiving the, I guess that's the interest.
Yeah.
The 900,000 is the interest.
Yes.
Okay.
But I could also technically raise the value of the property also
Yeah.
by adjusting for that 200 and whatever something $1,000 difference in present day dollars.
And still get the bank rate that they're
Right.
See, that's what you didn't say.
Right.
So that's how you would inflate the
That
price.
would be one of the things we could do.
Have you ever heard of like selling, like doing like the lease option or owner financing and then selling on different terms to like arbitrage?
You could.
Like selling on a wrap?
No, you can also, yeah, you can do a wrap. We're probably gonna talk about wrap loans next week.
I'm literally like fumbling my way through my first wrap deal right now. And that's why I was asking you about like the homestead exemption, raising the taxes.
Right. Well, there's also, what I normally will cover is to talk about situations of where you've got like things like